Imagine you're sitting inside a dark control room. Above you, numbers flicker across massive screens. Charts pulse. Warning lights flash red. And a voice echoes through the room. Warning. Risk elevated. Rate pressure rising. While you're panicking, the market is already playing a game you can't see. A game between central banks, institutional whales, and a Bitcoin price balanced on a razor's edge. Right now, we are standing at one of those rare historical turning points where macroeconomic forces are pressing down on the fragile structure of the crypto market. Over the past several weeks, the Federal Reserve has reinforced the idea of a higher for longer rate environment, meaning interest rates could stay elevated longer than investors hoped, as inflation remains stubborn. And what happens when traditional investors shift into defensive mode? Risk assets feel the pain first. Sentiment flips to risk off. Capital flows out of speculative positions. And Bitcoin comes under pressure. Let's talk about the hard numbers. Bitcoin has been trading in the $68,000 to $70,000 range after a sharp pullback, printing significant 24-hour declines and a weekly drop of over 10%. Spot volume has been rising, which often signals distribution rather than quiet accumulation. Meanwhile, futures open interest has been declining, suggesting leveraged traders are getting flushed out. Technical indicators like the RSI are leaning toward deeper support levels. This is the kind of setup that historically precedes volatility spikes, sometimes violent ones. Under the surface, on-chain data is telling a deeper story. We're seeing large Bitcoin transfers, wallets holding more than 5,000 Bitcoin, moving coins to centralized exchanges. That's not random. When whales send coins to exchanges, it often signals preparation. Either profit-taking, collateral management, or positioning ahead of potential stress events. At the same time, holdings in U.S. spot Bitcoin ETFs have declined from approximately 1.36 million Bitcoin to around 1.27 million Bitcoin, roughly 90,000 Bitcoin flowing out of that institutional demand pillar. Think about that for a moment. 90,000 Bitcoin. That's not retail panic. That's structural movement. Now imagine this dynamic like a giant beach ball being forced underwater. The deeper you push it down, the more explosive the release can be. But before it explodes upward, it sinks. And right now, key support levels sit between $68,000, potentially $62,800, and even below $60,000. These are critical zones. If they hold, the market stabilizes. If they break, we could witness what traders call final capitulation. Weak hands forced out, liquidations cascading, fear peaking. But to fully understand this moment, we need historical perspective. In 2017, before the first major crash, we saw euphoria everywhere. Retail piled in. Whales distributed quietly. Then the reversal came fast, what many later called the bursting of a bubble. In 2020, after the COVID crash, the Federal Reserve unleashed massive liquidity and slashed rates. Bitcoin exploded from around $3,800 to over $60,000 within months. Liquidity fuels risk. Tightening chokes it. Then in 2024 and 2025, ETF flows, institutional narratives, and macro tailwinds pushed Bitcoin beyond $115,000. Spot ETF inflows reached billions in single weeks. Institutions finally had regulated access. Demand surged while post-halving supply tightened. That supply shock narrative became real. But now, in 2026, the script is different. The Fed is not aggressively cutting. Inflation hasn't fully retreated. And while equities and other risk assets are already wobbling, Bitcoin is facing a critical stress test. Major U.S. spot ETFs like IBIT, Bitcoin, and GBTC have experienced significant outflows this year, including single days where IBIT dropped more than 13% and billions exited the market. Here's why that matters. Institutional demand was the structural backbone of the last rally. If that backbone weakens, even temporarily, the market becomes vulnerable. And the whales know this. They feel structural shifts before you do. That's why on-chain metrics show large addresses accumulating during weakness, while smaller traders take profits or exit in fear. Picture it like this. The whales are standing at the shoreline, watching you from the shallow water like sharks. They see positioning. They see liquidity pockets. They see where stop losses cluster. They know something you might not yet see. Historically, large address accumulation phases often precede strong upward expansions, but only after consolidation and liquidity hunts. And that's the key. We may be entering a phase where the market searches for liquidity, pushing lower, triggering fear, shaking out leverage before stabilizing. Another critical catalyst is just hours away. Upcoming macroeconomic data releases, inflation prints, and key economic indicators could confirm whether the Fed's hawkish tone remains justified. If inflation comes in hotter than expected, rate pressure increases. And that could trigger a sudden sell-off across all risk assets, not just Bitcoin. This isn't fear-mongering. It's macro correlation. Markets are interconnected. The Fed pulls a lever and dominoes fall. Bitcoin, as one of the most sensitive risk assets, often reacts violently to shifts in liquidity expectations. But now listen carefully. Markets are often most interesting where pain is greatest, where panic is loudest. The seeds of the next move are quietly planted. Despite headwinds, institutional investors have not vanished. Spot ETFs are seeing not only outflows but occasional rebound days with significant inflows. On-chain data since December shows large wallets steadily accumulating during weakness. That suggests that the players who truly understand market structure are positioning, quietly, patiently, strategically. So what does this mean for you? It means separating emotion from data. While headlines scream crash and social media amplifies fear, the charts are telling a more complex story. A market testing its structure. A market probing for liquidity. A market approaching a point where either a base forms or a deeper liquidation zone is triggered before the next expansion. Here's the crucial insight most traders miss. The biggest moves often happen after maximum discomfort, not before. When you're most tempted to walk away, strong hands may be stepping in. While you're staring at red candles, whales may be calculating long-term value. The market is playing a game you don't see. A game of patience, of volume absorption, of liquidity engineering, of macro timing. So let me ask you directly, do you believe this Fed pressure will trigger a true Bitcoin crash? Or is this just temporary macro headwind before the next major bull expansion? Drop your thoughts in the comments. I genuinely want to see where you stand. Debate it. Challenge the narrative. The best insights often emerge from collective perspective. At the end of the day, you're not just a spectator. You are part of this market. And now you understand the structural forces behind these moves. Forces many traders and even some institutions overlook. Bitcoin is at a crossroads. Macro noise is growing louder. The Federal Reserve is tightening the psychological screws. Whales are repositioning. Liquidity is shifting. The only real question is this: will you understand what the market is preparing before it's too late?